in a window of time as short as 60 minutes. 60 minutes! A staggering $7 trillion in value was just gone, wiped from the market. Now, this wasn't some slow, gradual decline. No, this was a liquidation cascade, a sudden, absolutely brutal drop that caught pretty much everyone off guard.
And you know it's bad when the analysts start calling it this, the red candle of death. I mean, when you see a phrase like that trending, you know something serious went down. It just speaks to the sheer speed and the insane magnitude of this sell-off.
So yeah, this historic crash actually broke a record that goes back over 100 years. The real mystery here is, was this just some crazy market volatility, or is there something much more complex happening just beneath the surface? And just look at the numbers here. They are absolutely dramatic. Gold, which was trading strong at $5,600 an ounce, just plummeted below $4,900. But man, silver got hit even harder. It collapsed from a high of $121 all the way down below $85. To put that into perspective, for silver to have its worst day in 103 years, that's not just a bad day at the office, you know? That is a record-breaking collapse that just screams for a deeper explanation.
Okay, so the first, and let's be honest, the most obvious trigger for this whole mess, it comes down to one thing, the US dollar. If you want to understand precious metals, you absolutely have to understand the power of the dollar.
The key metric you gotta watch here is something called the DXY, or the US dollar index. Just think of it like a scorecard for how strong the dollar is compared to other major world currencies. And believe me, the pros watch this thing like a hawk.
And here's the relationship. It's actually super simple. Precious metals and the dollar, they're on opposite ends of a seesaw. When the dollar goes up, it takes fewer of those now stronger dollars to buy an ounce of gold or silver, so naturally their price goes down. It's a classic inverse relationship.
So the big question is, why did the dollar suddenly get so strong? Well, the Federal Reserve sent out what they call hawkish signals, which is basically code for interest rates might stay high for longer than you think. The second that news hit, professional institutions just dumped their metals, leaving a lot of retail investors holding the bag.
But you know, the dollar isn't the whole story. It never is. The story gets a whole lot more complicated when we start adding two other massive pressures into the mix. And this really explains why silver, in particular, just got hammered.
See, unlike gold, silver has a day job. It's a critical industrial metal. More than half of all silver demand comes from industrial stuff. We're talking solar panels, electric vehicles, semiconductors, you name it. This makes its price super sensitive to what's going on with the global economy.
And right now, the world's factory, China, is showing some serious signs of a slowdown. The latest data is pointing to manufacturing and factory output actually shrinking. And for a market that completely relies on industrial demand, well, that news sparks instant and widespread fear.
And then, just to pile on top of all of that, we've got this massive political catalyst looming on the horizon, a potential US government shutdown at the end of January. The markets are already pricing in an 85% chance of this happening, and in times of crazy uncertainty like that, traders often just sell everything, including safe havens, to raise cash.
So, okay, a strong dollar, a slowing China, and political chaos. That seems to explain it all, right? Case closed. But is that really the whole story? The source material we're looking at suggests there's a huge divergence that most people are completely missing.
And this, right here, is where things get really fascinating. We need to talk about the massive disconnect between the paper price of these metals, what you see on your screen, and what's actually happening in the real, physical market.
It's like we're looking at two totally different worlds at the same time. On one side, you had the paper price on the COMEX exchange in the West. That's what we all see, and it's crashing. But on the other side of the world, in the physical market in Shanghai, the price is signaling screaming unbelievable strength.
How strong? Get this. Physical silver in China is trading at a premium of over 43%. That means buyers over there are willing to pay an extra $37 per ounce over the paper price just to get their hands on the actual physical metal. That is a massive signal.
And the evidence for a physical squeeze just keeps piling up. There are already 9.4 million ounces of silver demanded for delivery in February. We're seeing huge banks like Wells Fargo and JP Morgan frantically issuing and then stopping delivery notices, which suggests they're scrambling for metal. It's leading some analysts to believe this was a deliberate paper slaughter designed to shake out weak investors right before a physical supply squeeze really hits.
So with all that going on, where in the world do we go from here? Let's take a look at what history tells us, some practical takeaways from the source, and a pretty bold prediction for the next few weeks.
You know, the craziest thing is, we've kind of seen this movie before. According to the source, an almost identical crash happened back in December of 2022. And what happened next? It was followed by a massive rebound in January, with gold jumping 30% and silver just exploding over 65%.
So what's the takeaway here? The source offers a few key points. For anyone holding physical metal, the advice is simple: do nothing. This is about long-term wealth insurance. For traders, it's a huge warning that using leverage in this market is basically a death sentence. And the prediction? That silver could snap right back to $120 by the middle of February.
And it's so important to remember that despite all this short-term panic, the long-term fundamental reasons that were driving prices up in the first place, they haven't changed one bit. Central banks are still buying, there's still major supply deficits, and that big trend of de-dollarization is still rolling on.
Which really leaves us with this final question. Was this a 60-minute panic event designed to shake people out of their positions? Or is this divergence, this gap between the paper crash and the incredible physical demand, actually signaling a much larger decade-long opportunity? Now that is something to think about.